if everyone will take your seats, we'll get started. And this isn't a Baptist meeting, so you can move to the front, if you will. So we want to thank you for coming today, and thank Chairman Morris for allowing his committee to join with us in the Small Business Development Committee. We look forward to the information that's going to be presented to us today. As luck would have it, we scheduled a meeting at 2 o'clock on adjournment day for the week. But hopefully it works out that we have enough attendees to really help us carry forward in what we want to do. So if you'll, those attending, if you'll silence your cell phones, and we'll get started, and we'll begin our meeting by asking Representative Williamson if he'll lead us in a word of prayer. Which one? Okay.
Hello.
Got it.
Thank you, Mr. Chairman, or Chairman. Let us pray. Gracious Heavenly Father, Lord God, we do thank you for the beauty of this day, Father. We just thank you for the love that you have for each one of us, Lord, and we pray that all of our thoughts, actions, and deeds be reflective of your love for us in our lives, Father. Pray that you bless our families, bless all that are gathered here trying to implement good policy in the state of Georgia, Father. May everything we do be pleasing in your sight. We ask for traveling mercies, Father, as we wrap up the business this afternoon in time of rest and relaxation with our loved ones, Lord. And all these things we ask and pray in Christ's name. Amen.
Amen. Thank you, Representative. Well, we're honored today to have our good friend from the Department of Community Affairs back with us. Earlier, or before the session started, Holly Hunt met with us and gave us an exceptional discussion on the SSBCI program, and at that time she offered to come back. We tried to cover a lot in a short time, and she graciously offered to come back, particularly in the area of banking and lending institutions, and help us get a better insight into this aspect of this initiative that our state's involved with. So we're honored today to have with Holly the Deputy Commissioner of Community and Economic Development in the department, Mr. Christopher Nunn. And at this time, we'd be honored, Mr. Nunn, if you are you prepared to just Holly? Okay, thank you, and thank you, Holly.
Thank you for having me back, Chairman Epps. I think he knows how much I love this program and how much I love to talk about it, so he keeps asking me to come back and talk, and that I can do. And thank you so very much. And thank you all for being here. I appreciate it, especially when I know you could go home. That's even more appreciative. So I'd also like to introduce my SSBCI program specialist, Tim Smith. Tim, raise your hand. Tim is our marketing and outreach person. Tim is the one that actually helps me go out and talk with the banks and the lending officers and enrolling the banks into this program. You'll see that this program, it can't happen without the participation of our banks and private lenders in Georgia. So it's apropos that I'm here to speak to the Banks and Banking Committee today. So what is SSBCI and why do we need it? These slides will show you what the economy looked like in 2010. You see that the quarterly petitions for bankruptcy peaked in February of 2009 and stayed strong through 2010. Likewise, the unemployment rate looked about the same. If you'll remember, Georgia was leading the states in bank closures during this time period. I'm sure you remember that well. So this has been a particularly wonderful program for the state of Georgia. Next slide. So the congressional response to the the issues at the time was the State Small Business Credit Initiative Act of 2010. And what it did is it set aside $1.5 billion in federal funds to be leveraged with private dollars in the amount of $15 billion. So that's a 10-to-1 leverage that we need to meet by the end of the program goals. They then had to allocate that $1.5 billion amongst the states, and they needed to come up with a way to do that. So what they did, next slide please, was they looked at the unemployment rates and the economy for all the states. The national unemployment rate was 9.6%. Georgia was 10.2%. Georgia was the 7th worst state, and so Georgia received the 7th most amount of money. Georgia received right at $48 million. We trail behind those that you see in the pie chart, and I wanted to make note that our sister southern states, Alabama, North Carolina, Florida, they are right in the mix as well, and we all work very well together in referring banks that cross the state lines and borrowers as well. So we're a very close-knit group that administers this program together. Next slide. So once the monies were allotted to the states, Governor Deal was then challenged with who was going to administer these funds. And because the DCA, through the Georgia Housing and Finance Authority, had experience in managing state and federal economic development programs, he designated the DCA through GHFA to administer the funds. Next program. This slide is to show you that DCA was rather serious about the administration of these funds. John Kingery is our credit manager. He's been with the DCA for 20 years, and before that he spent 15 years in the banking and business finance areas. He was the mastermind behind these programs. He reached out to me and hired me on to be the state program manager. I've got 23 years of experience in community banking. I was an organizing CFO for 3 de novo banks in North Georgia. I spent 6 years after that as a CFO for a CDFI in North Georgia, and I'll explain CDFIs later. It's a very important component of this program. We have been lucky enough, Georgia's done an outstanding job of reaching the underserved markets, which is the mission of the program, and we were asked to co-chair for the Treasury Department, the best practices for underserved markets. I co-chaired that with the state of Montana. And currently I've been asked, one of 7 state representatives from the U.S. Treasury, to sit on the committee for sustainability. As the program comes to a close at the end of this year, we drop off the federal oversight and then we continue the programs on our own with the state of Georgia. So I've been asked to help on that committee on how to keep the program sustainable with all states after 2016. Next slide, please. We also, like I said, I have Tim Smith. He has over 22 years of experience in commercial and SBA lending. After Tim came Alan Jacobs. He is our loan analyst, and he has over 22 years in bank experience as well. So now that we had the folks on board, Georgia didn't have a program like this that they could pump the money in already. So Georgia had to develop programs to be approved by the Treasury Department. So we started off with 3 programs. The first is the Georgia Funding for CDFIs, and what I'm going to do is I'm going to touch on them briefly, and then we're going to talk about them in detail. And so I'll explain each one a little bit better in just a few minutes. We allotted $20 million to this program. The next program is the Georgia Small Business Credit Guarantee. It's a 50% guarantee program. We allotted $17.8 million to this one. The next one is the Georgia Capital Access Program. We started off with $10 million in this one, and this program has not been received well. So what we did is we lowered the amount to $2 million. And with the next slide, you'll see we developed the Georgia Loan Participation Program. This is a true loan participation program where one bank, generally one bank will participate with another bank, especially on the larger deals in your communities. Well, what they can do now is they can participate with the state of Georgia, and there are no fees. And so we'll talk about this in detail as well. Next slide. So let's talk about some of the advantages on why banks would want to do this. Each program offers credit initiatives, various credit initiatives to the banks in order to get the banks comfortable with making the loans to the small borrowers. So we have the credit enhancements. It's a delegated lending model, and that means that we don't underwrite, we don't set the terms, we don't set the rates or anything. What we do is we have a vetting process, and we vet the banks that want to be approved lenders. We approve them into the program, get the agreements and all set up, and then we rely on their underwriting guidelines because each bank in each community underwrites very differently, I'm sure you know. And we just get comfortable with their underwriting. When the loan package comes to us, the paperwork is very minimal. We can then streamline it and move it through fairly quickly. There is potential for CRA credit. I'm sure some of you know what that is, some of you may not. CRA is Community Reinvestment Act. It was enacted in 1977, and it incentivizes the banks and the financial institutions to invest in their local communities, especially in the low to moderate income areas and to the underserved markets. So they do get CRA credit by participating with this program. It's a very streamlined process. They send us the paperwork, we review it, we get it out, and we can generally turn it in 5, 10, 15 days, depending on the size of the loan and the complexity. And we have done some complex loans. And it allows the banks to increase their loan portfolio by making loans to small businesses they wouldn't normally be able to make. There's a but if not for clause. But if not for the SSBCI program, we would not be able to make this loan because it could be loan to value. It could be the banks, it would be over the bank's legal lending limit. We can help them make the loan and stay below their legal lending limit. It could be that maybe they don't, their policy is that they don't do loans to startups. Banks don't like startups. We've done a lot of startups with this program because anything that's outside of their tolerance, we can help them with, and then the regulatory agencies acknowledge that that's what our program is there for. So they don't get any black marks from the regulatory agencies for doing so. It's very important for the bankers to understand that. For the small businesses, what does it mean? They can then get access to very affordable capital that they couldn't normally otherwise. And a lot of these borrowers, they are credit worthy. They just can't get the capital they need for some reason. The banks still with the regulations, they've really tightened up. And so with our credit enhancements, we can allow them to gain that access to that capital they wouldn't or otherwise be able to get. We've done a lot of expansions and new startups into new markets for them. They now have access to expertise from their bankers, from the DCA staff, and if they participate in the CDFI program, they also have access to free technical assistance. That's very important for some of these small businesses, especially the new ones getting started. It allows them to establish banking relationships where once they had none, and of course it allows for a stronger financial condition for the small business. So let's talk about the Georgia funding for CDFIs. A CDFI is a community development financial institution. They are nonprofits, and they got their start with the microloans, small microloans. Have anybody heard of those? They started off at $35,000 and under, and then they went up to $50,000 and under. And now with access to our capital, they can do loans in excess of $50,000. They target the underserved markets. And the mission of the Treasury program is to reach the rural and the underserved markets. Georgia decided we were going to adopt the same mission, and so we enlisted the aid of the CDFIs for that purpose. They're already in those markets. They've been lending in those markets for 25, 30 years now. Bankers don't necessarily like to go in that market. It's not their target market. And what they do is the banks participate with the CDFI on these loans. It's a companion loan program. And so say I'm a borrower and I go into my local banker and I need $100,000 for a startup business. And they say, I'm sorry, Ms. Hunt, I can only do $60,000 for you. I might only have $10,000 of my own money to get started. So there's that financial gap there. What we can do through the CDFI is the CDFI can do that gap loan We finance 100% of those funds to the CDFI to lend to the borrower. The borrower now has 2 loans. The beauty of this program is the CDFI loan does not have to match the rate and the terms of the bank loan. So if they have a cash flow problem, it could be that perhaps, and we try to get the CDFIs to do a lower rate than the bank so that you have a blended lower rate to the borrower, and the CDFI can also stretch out the terms. So if they have a cash flow problem, you can stretch the term out a little bit, lower the rate, and help with the monthly cash flow on those. They close simultaneously. The CDFI is the lender, approved lender in the program. Banks do not have to be an approved lender in the program. This is where we pick up most of our participating banks, because the banks never have to deal with us. They never have to deal with the state. They deal directly with the CDFI, who then handles all the paperwork for the state. The CDFIs are contractors on behalf of the state. They market the program, they administer the program, they do all the reporting for me on the reports that have to go to Treasury. I simply have the oversight on them and review their monthly reports before sending. For the CDFIs, the principal repayments, when they come back to the CDFI, the principal is then used to revolve back into their communities, and they retain the interest and fees to handle the administrative cost of the program as our contractors. Those funds do not come back to the state. But what's very, very important is we deal with 5 CDFIs throughout the state that geographically cover the whole state. So we've left no geographical area in the state of Georgia untouched by this particular program. What these funds do is they're there in those communities to revolve in perpetuity after the program ends. Are there any questions on the CDFI program before I move forward? This has been, they've used up their $20 million already, and now they're into their revolving loan fund, so it's wonderful because now I'm leveraging that money again and again, so my leverage numbers are building, which is part of my mission. So we're pretty happy about that.
I can do that. Do you, what type of terms do these loans usually have? Are you looking at 5-year with a balloon, or what kind of terms?
They vary. Most of these have been the larger loans. Some of them have 7-year terms. The CDFIs will sometimes go out to 10-year on a 20-year AM, depending on the need of the borrower. It just really depends on the need of the borrower. Sometimes the borrowers don't want to run that long. They want a shorter a payout period. I have seen some where both the bank and the CDFIs do 10-year terms on a 20-year AM. It's all across the board because we deal with states, banks all over the state, and each community is different depending on their needs. Any other questions? I have a quick example. This is one that we did, and I wanted to show you this one because we layered with other DCA funds. With this particular loan, it was a bed and breakfast in Monroe. It was a $700,000 project. What we did is the local bank did $348,000. $63,000 was with a low interest rate loan with the downtown. The Department of Community Affairs has a downtown development revolving loan fund. I'm sure most of you are aware of that one already. It's been around for a while. And the owners had $73,000 of their own equity. They still had a gap of $216,000, and we were able to do that with Georgia Cities Foundation, who is a CDFI and an approved lender with our program. So this was, we really like showcasing this one. Number one, it's a beautiful place. It's been very successful, and it shows you how we can layer with other programs. Next. This is also one we did. Y'all may be more familiar with this one. This is the 200 Peachtree building. It's an event facility. Probably most of you have been to events there. If you haven't, you need to go. It's absolutely beautiful. This is the old Davison's Macy's building. They needed about $11 million for renovations. They wanted to renovate some of the, create new ballrooms, create new event space, new meeting space, conference space. And we were able to go in with the Peach State Federal Credit Union. They did $8.7 million. Through ACE up in Cleveland, we were able to do $2.7 million, and the owners had $300,000 into the project. So this shows what we can do on some of the larger projects. And those are the two that I brought to you for the CDFI program. The next program is the guarantee program, and it's just that simple. It is a 50% guarantee program where the bank may have a loan, working capital, whatever. They just want a guarantee on it. They want to keep the funds on their portfolio because they want the outstandings to boost the outstandings on the bank. They just want a little bit of safeguard. So with the guarantee program, we can give them that, and they get to keep all the funds on the books of their bank. It's just that simple. They do have an option to transfer it from a 50% pool to a 10% pool, and what that does is it builds up a cash. The 10% pool acts like a cash reserve, and if they have a critical mass that they've enrolled in this program, let's say that they've got a $100,000 loan that's got $100,000 outstanding on it and it defaults. If they've got enough money in the 10% pool that's acting like a cash reserve, then they can take their 50% pool, add monies from the 10% pool, and they can claim up to 80% of the outstanding balance. So it's up to the bank on how they want to manage their pools, but they could get up to 80% reimbursement on a defaulted loan. And it's designed that way to allow the banks to choose where they need their funds. Very simple program. We have a borrower in this program that uses it. They've got over 200 loans with us right now, and they do working capital loans and they purchase accounts receivables. This has been extremely valuable for the small companies with high receivables. Generally, it's the accounting firms, the technology firms, and such as that have a lot of receivables. With this program, we're able to reach a lot of businesses, very small amounts. We don't move it very fast, but a lot of jobs created and retained with this program, and a lot of small businesses that we've been able to reach. Our next program is the Georgia Loan Participation Program. First, are there any questions on the guarantee program before we move ahead? Thank you. With the loan participation program, it is just that. Where the banks would normally participate with each other, they can participate with us instead. Or we've done loans where there's 5 or 6 bank participations on the large loans, and they bring us in as another participant. We participate with the lead bank. The lead bank then goes and has a lot of other participants out there. And I've got some examples of that to show you in just a moment. We can purchase up to 25% of the bank's loan up to $5 million. So the max we can go is $1,250,000 on any one loan. However, if a bank has loans up to $20 million, we can't go be in any project where the total loans exceed $20 million. We can still participate. We're just capped at the $1,250,000. The LPP program is also very good for SBA 504 financing, if any of you are familiar with that. 504s are generally you have 50% bank, 40% SBA, and 10% borrower. There is generally a construction phase, and during that construction phase, the bank is at risk for 90% because the SBA doesn't pay out on their debenture until the end of construction when the permanent loan goes in place. The bank doesn't like that 90% at risk, and so a lot of banks haven't gotten into this arena for that reason. With our LPP program, we can go in, or really any of our programs, we can go in during that interim phase and participate with the banks during the interim, lower their loan to value and their risk during that phase. And then when the SBA comes in to take it out, they take us out as well. We can never be in a program, in a loan at the same time as USDA, SBA, or anything like that, but we can help participate on the loan until the debenture pays out. It's been widely popular with that. We like it because then we get our lump sum monies back to be relent back on the street, which then helps with my leverage. So it's been, we're pretty proud of that part of the program. To give you some examples on this one, this is one we really like to showcase. This was a project down in Rock Eagle Science Technology Park in Putnam County. The technology park went in and sat empty for quite a while, and the Georgia Department of Economic Development was actually working with these two companies on trying to get them to move their headquarters from California to Putnam County. I was contacted by the bank and then the borrower, unbeknownst to to the fact that GDED had been working with them for about 5 years on this program. Finally, we connected to figure it out, and we worked with GDED to make this happen. They did go into the technology park. They did move their headquarters from California. What they do is, I think they were planning on moving about 65 people from California and then hiring an additional 40 or so when they started, and they hope to have up to 500 employees or more within the next 4 to 5 years. They're also going to be using our local students from Georgia Tech, University of Georgia, and a local technical college on their internship programs and such as that. So it was a win-win for everybody. And I believe all of their salaries averaged over $50,000. So that was a huge influx of folks and income for that particular county. You'll see that at the time we were able to layer our programs. We can't do that anymore, but what we did is the LPP went in for $1,250,000, the CDFI went in for $500,000, the lead bank was $4.9, we had another bank for $2.2, and the owners put in $989. So that was one of our more complex ones, and we got through that very gracefully, I might add. So general eligibility. We've talked before about startups and working capital. You know, those are two phrases the banks just don't want to hear when you walk in and you say, I need a loan I'm a startup and I need some working capital. They don't like that at all. But we have done a lot of that with these programs. Quite proud of that. We can also help purchase businesses, franchise fees. We can do equipment and inventory loans, construction, renovations, tenant improvements, and such as that. So the only thing we can't do is any place of a legal business, which banks wouldn't do that anyway, and neither would we. Refinancing is not eligible. That means if a bank has a loan on their books that has not reached maturity and it's troubled and needs to be refinanced, we cannot do that. However, if the loan has reached maturity and they need to renew it, we can go in and enroll those loans as long as there's some new money involved and a new business purpose. We have done a few of those. We cannot do passive real estate investments. We do follow the rules of SBA. If it's a strip center or something like that, as long as the owner is going to occupy at least 51% on existing or 61% on new construction, yes, we can help. We cannot do mixed use. There cannot be any residential involved. It's strictly a small business program. And yes, we've done several of those deals as well. A little bit more complicated, but it can be done. Any questions on the loan participation program? So let me show you what we've done so far. This is my favorite slide. We have got 331 loans enrolled. We've put out $32.9 million with our SSBCI funds. We've leveraged $175 million in the private sector. Yes, that is $175 million that the banks and the credit unions did on our behalf that they wouldn't have normally been able to do. We've created and retained over 3,000 jobs. We're in 60 counties, and you all have a map because this slide is very, very tiny. So I printed this off for you. This is a map of our coverage. So any of you that are in the areas that have no color assigned, that means you need to call us and invite us into your communities to talk to your bankers and your small businesses and see what we can do to help in those counties. We have 44 participating lenders. That includes the companion loans lenders with the CDFI program as well as the approved lenders. On our website, which is listed at the back of this program, you can go on and see all of our approved lenders. We have them all listed. We have their contact information and their websites if applicable. So at the end of the program, what are we going to do? Well, this is our plan. This is our sustainability plan. We're going to take that $2 million in that CAP program that nobody's using. We're going to move it over to the loan participation program. We're going to take $5 million out of the guarantee program, move it over to the loan participation program. Why are we going to do that? Because the loan participation program earns me the most interest income. There are no fees on that program. It's merely interest. But right now I'm averaging 5.25% on my return on investment with that program. So with $15 million in that program revolving in perpetuity, that will give me enough to sustain the program at DCA for years to come, I hope. The next slide is our information. You see mine and Tim's information here. This is our website. I encourage you all to look at it. We try to keep it updated with our approved lenders and such. We have each of our programs listed on the website, and when you click on the program, it will bring you up a page. It will be a summary page. It tells you a little bit more about it. The documents for those programs are at the bottom. They're downloadable. You can download them, and you can look at the agreements, the legalese, and at the end of the agreements are all the forms. There are not very many. We have two major forms that the banks fill out. One the borrower fills out, one the bank fills out. They send me a credit memo, some tax returns depending on the size of the loan, and we just simply review it and send it back out with approval. It's a very streamlined, easy process. And that is it. Are there any questions? Thank you so very much. I appreciate it.
Oh, and thank you, Holly. We truly appreciate you coming back. Chairman Morris, any comments?
Oh, no. Enjoyed being here. And I thank everybody for staying and paying attention. It's very important. Thank you.
You know, in the chamber this morning, we had a comment about in-service training for legislators. Since some of you stayed past adjournment, we'll offer 5 credit hours in small business and joint banking for in-service training for this. Thank you again, Mr. Dunn. Thank you, Tim, for coming and being with us. Hopefully this is some information that you, as in your legislative capacity, can carry back to your district and help small business entities there, or anyone that has a need that certainly that Holly and her staff can work with. We encourage you to do that. I might add, she is available. She is very responsive, and if you have the need to contact her personally, then please take advantage of the information, contact information she's offered you. We wish you all safe travels. Have a great weekend, and look forward to seeing you Monday morning.